I want to ask you, you have had a lasting career on Wall Street, and you and I were just kind of reminiscing about the times that we've talked over the past years. You've seen numerous cycles. I love when someone has. How would you describe today's cycle?
Okay, so I think there's elements of today's cycle that we've seen before. I think we can see elements in this cycle on the economy side to the environment of the late 1990s, right? When we had an innovative technology, there was heavy investment going into it. So similar to what we're seeing today, but there are also very big differences between the two, right? The investment happening today is coming from companies that have earnings. In the late 1990s,
big difference.
That wasn't the case. Yeah. So there are very important differences, but then also similarities, the impacts on productivity growth. So in the economy, I think we can say we've seen some parallels, but we have to distinguish. And the other thing I think is interesting is if we think about the Fed and how the Fed evolved over the various leaders that we've had for the past couple of decades, say. And now in some sense, when you look at the Fed under Kevin Warsh, there does seem to be maybe some shift back to the way things were before during the Alan Greenspan Fed, when communications weren't as extensive as they have been since Greenspan. I think that those changes started under Greenspan, and now I guess there's this feeling that maybe it went a little too far, and it's better for the Fed to talk less. So, it is interesting to see how things can sort of shift between the eras.
What about the era of stock bond correlation?
Mm-hmm.
Because you noted that, things are changing. Maybe bonds aren't a safe haven that they used to be. Is that because of this new Fed era that we're in?
I don't think so, because I think that correlation broke down before we had the Fed transition. And so, one of the things that we noted is that ballast that bonds that they provided in the past, we weren't really seeing it anymore, and so that the correlations were more aligned than we would have liked them to. So we started looking at what other assets can investors use to protect themselves, and gold was one of them. That's an asset that we've been recommending for quite some time. And it's an interesting one because gold has obviously moved around a lot in the past several months,
right?
Which raises questions about whether it's still providing a ballast. And our answer is we think it is. Our view on gold is much more of a secular view, and we think that it has an important place in investors' portfolios in this environment where we have the equity market performing very well, but questions about the certain sectors of the equity market, in the AI space, are we going to see the returns from all the investment that's being done? And then in the bond space, all the questions about we have globally fiscal ratios that are concerning to people. And I think that's in the back of investors' minds, and maybe one of the reasons.
Is that different this time around? Because, again, I would go back 15 years or so, and we'd have this conversation about concerns about the fiscal position of the United States or other countries. Is it different, though, in terms of the fiscal state of not only the U.S., but other governments, as you point out?
Well, I think that one of the differences is just the levels of debt, right?
Yeah.
So we need to, if we're looking at in terms of GDP, which a lot of people will argue maybe that's not the best way to look at it, but it is a very common way to look at it.
Kind of a clean metric, I would say.
It's a clean measure, but there's even people in very senior roles like Janet Yellen who, as Treasury Secretary, said that we should be looking at other things like the interest cost of that debt in real terms, for example. But as you said, a clean way to look at it is look at debt ratios, debt deficits relative to GDP, and those are high, and so we have debt as a share of GDP. You'd have to go back to World War II to see levels similar to what we're seeing now. We have very large deficits in an economy that is in good shape, and I think that's the aspect that might be a little bit concerning to investors. That if we have deficits this large when the economy is growing quite solidly, what happens when we inevitably have that downturn and spending has to go up?
Because how do you grow yourself out of it if you're doing kind of already well?
Or how do you stabilize, right? One of the hopes of deficit spending is that it provides a temporary stabilization for the economy to kind of find its footing. Mm-hmm. And the concern, I think, is that given that deficits are already so large, will there be that fiscal room to provide that stabilizing force the next time we have a downturn, whenever that is?
To what extent does the strong consumer kind of provide a little bit of cushion here for that scenario? Because you noted that the consumer's been pretty healthy. Mm-hmm. They've been spending.
And I think that has a lot to do with the labor market. We had an employment report last week on Thursday. I think a lot of people sort of wrote it up as being somewhat disappointing, but I would say, we have to look at the trends in that report, and we have employment growth that's still averaging 100,000 per month over the last 3 months, close to that for this year thus far. And you compare that to 2025 when employment growth really didn't grow at all. And then think about that growth in the context of labor supply that's growing very slowly. So to bring that back to the consumer, it looks like job growth is strong enough to absorb entrance into the labor force. Wage growth is pretty solid. And I think that that's what's providing the support to the consumer and why the consumer is holding up quite well.
And of course, we would remind everybody, and we talk about this, the K-shaped economy, not all consumers are doing well. We still see a lot of consumers in America, struggling just to get by. Having said that, if the labor pool is not increasing, and we've talked about the impact of immigration and people not coming in to expand the workforce, that plays into my worries about how do you expand growth if you also restrict the size of the available labor pool. But it also speaks to existing workers maybe getting paid more, great, but it also speaks to wage inflation and inflationary concerns. Is that a problem? And got about 35 seconds.
Yeah, so I think that's really important there, but I would tie that back to AI, where we sort of started off, right?
Okay, yeah.
And we have that situation where we don't have the labor supply that we've had in the past, but we do have this other source of output in AI, and that boosts productivity growth. And so I do think that we have a growth outlook as a trend that is better than it was 10 years ago, even with slower labor force growth, because AI sort of picks up some of the missing workers that we don't have anymore.
Which goes back to Alan Greenspan and productivity gains.